So just a quick disclaimer, trading is a risky business and you do want to be aware of that and check in with a financial advisor before you go ahead and make investments or trades. So this presentation, we're going to have a bunch of charts, and they've all been created with Infinity's Active Trader charting package, along with the Trade Guider Smart Scan plugin. Kind of cool. You'll see that I'm old school, and Gavin and Tom Williams have sort of the new school, but it's kind of cool to pull them together. So let's take a look at what we're going to cover today. Excuse me, I'm going to just do a very brief history lesson. Why Wyckoff? Why Williams? Who are they? Why are they important in all of this? And then we're going to get into what I believe, what I've found to be the essential playbook in Wyckoff. These are trade setups, and they're only going to be two basic setups. Springs and upthrusts are one. They're mirror images of one another. And then what I call the sweet spot in trading trends, both up and down. So basically, I'm going to show you two basic trade setups. But as we do that, we're going to go through a bunch of principles that Wyckoff either discovered or describes. We're going to talk about supply and demand, effort versus result, a little bit about accumulation and distribution, trend characteristics, the conditions of being overbought and oversold in the trend, market structure, which I think is so important, and I'll emphasize that as we go through this presentation. We'll look at climactic action and shortening of the thrust. So even though we're only going to talk about two trade setups, we're going to pack it with a lot of information on market principles. Okay, so who's this guy Wyckoff? He was born in 1873 and died in 1934. When somebody first said to me, you ought to really look at Wyckoff if you want to understand technical analysis, I thought it was a new indicator. Where can I get this trading package, right? But no, it was a fellow here who, at 15 years old, he came to Wall Street and was a runner on the street. Telephones were the big new technology of his day, so they used to run orders back and forth between the office and the floor where they were trading. By the time, though, he was 25, he opened up his own brokerage company and could see the maneuvering and the actions of the large traders of his day, including people like Otto Kahn, J.P. Morgan, I'm sure you're familiar with that name, right? Jesse Livermore, perhaps the greatest trader that ever lived. And he, in fact, Wyckoff wrote a book, a small pamphlet on Livermore's trading. Jay Gould and James Keene, among other large players. He would sit around sort of the Cracker Barrel at the end of the day and say, oh, Keene is buying Reading Railroad. And his friend, another brokerage firm, be saying, oh, he's not buying, he's selling in my firm. So they began to understand how all this stuff was working amongst these large players and the public, and they were also able to translate it to the chart. Okay, so interestingly enough, Wyckoff started basically a newsletter, an early newsletter called the Magazine of Wall Street. He had so many subscribers in his day that he actually was able to move the markets. When he would make a recommendation on a stock to either buy or sell, it would often have a large influence in the markets. He was also the first person to write a manual on day trading called Studies in Tape Reading, 1910. Did it under the pseudonym or the pen name of Rollo Tape, but that was Wyckoff. And then he also wrote two courses. Towards the end of his life, he was always concerned with how the public was kind of being fleeced by the large operators in the what they called boardrooms back then. They'd have the ticker tape across the board, running across the board, and he wanted to try to help the public understand better what was going on in the stock market. And so he wrote two. They were actually correspondence courses, one on stock trading, and just before he died, he published day trading manual as well. And these are still available from SMI. So then Wyckoff, we're interested in him because he was a pioneer in the study of the tape. They would have a ticker tape, and he would take the information coming off of the ticker tape and put it down. He often used a point and figure chart with volume, and he would record that and then make trades off of that. He was the first one to look at volume. I mean, he would have lunch with Charles Dow I think it was every Thursday or Wednesday. And, you know, Dow theory and all that. And Wyckoff was very interested in that, but he was also, as Tom Williams was talking about a little bit earlier, volume being so important in this. He also either described these or coined these ideas of support and resistance, accumulation and distribution, testing, which is so important to us, terminal and ordinary shakeouts, supply and demand, effort versus result, all these different aspects of the market that we now use in our trading to great effect. So now, 50 years later, Tom Williams comes on board, and as he kind of talked about, he drew the charts for a hedge fund or a syndicate, and they saw that he had aptitude in the market, so they sent him to, they got the Wyckoff course for him, and he became a trader. I think he retired at 40. Was that right?
He moved back from Beverly Hills at 40 years old.
Yep. Came back to England, to Worthing, England. That's where he's got his house there, a nice house. At 40 years old, the ripe old age of 40 years old. But Tom's got a very active, he's very active mind, and just putting around in his garden wasn't going to cut it for him. And so he started to think about, computers were new, very new at this point. He started to think about, could I take the things that I learned trading in California and apply it to computers? And he originally started with Genie software.
28 years ago.
28 years ago, yeah, 28 years ago. Developed the idea of volume spread analysis, originally called it Wyckoff VSA, if I recall correctly. That evolved into Trade Guider, and now there's the plugins and all of that. So Tom took the technology, and Gavin, correct me if I'm wrong, he's been involved in every aspect of the development of the software from the get-go to today.
He's still, he checks the indicators even today, but he's losing his sight, unfortunately. But
yeah,
right.
Yeah.
He does get active.
But he's still active with it. Well, the computer part is important, but that's not the only thing. He also wrote this book called The Undeclared Secrets That Drive the Stock Market. And I think now you guys have it as Master the Markets.
Yeah, but that's actually still, you can still get that book.
You can still get this book, okay. Well,
it's Master the Markets now, yeah.
I would encourage everybody to get this book. In fact, I've read this so many times. Let me just, I know you won't be able to see it online, but this is what I did with this book, right? In fact, I read it so many times that the pages are falling out of the binding. And not only that, I rewrote this book in my own words, not to plagiarize, but just to understand in my own words what he was talking about. Because it's not easy to understand this, as you all know as traders. This is tough stuff. And I found Wyckoff is very dry to read through it. And what I found is that Tom's words really sung off the page for me. I really understood. It really spoke to me. So I thank him for that, more so than personally, more so than the computer stuff. This is just unbelievably good. A good.
And the reason he wrote that was actually because he was selling software without a manual explaining it. That's why he wrote the book.
And that's the manual for it.
That's it. Yeah.
Amazing. All right. So that's the history lesson. Let's get into the Wyckoff playbook. As I said, springs, upthrusts, and sweet spots. in the trend, which Wyckoff said the most important thing to know is the trend. It's the line of least resistance. So upthrust, just conceptually, we have a high at A. Let's see now if I can do this. Yeah. Everybody see this, the little red thing? You can see it here.
Yeah.
Okay. So we have a swing high that's painted at A on the chart. We come down with a reaction to B, and then the market continues to go back on up and revisit the highs. Sometimes it breaks through, and if it does, then we're off on a trend. We'll get to that in a little bit. But here, it's a failure to follow through. And this is where we look for an opportunity to enter the market, as the market is unable to rally higher. So I'll show you a few examples of this, and then we'll go to the spring and then the examples of trading in a trend. But then I'm going to take us back through last week in a few markets, a few futures markets, and see how these all played out, how they applied. So we'll look at this as kind of a conceptual map for ourselves, and then we'll look at how it gets applied. So you can see at A, we make a swing high, we react down to B, and then a failure to follow through at C. And we'd be looking to enter the market as it comes back down underneath the level of the high level of A. Okay? Now, what you'll notice too, I'm not going to talk too much about these. I'm going to talk more about the structure of the market and some of the volume and price characteristics, but not about the indicators that show up. You'll see a lot of times, for example, here's the end of a rising market in here. Okay, so you'll see on the Trade Guider software the indicators coming up right around the areas that we're interested in making trades. Again, another good example, this is on the daily crude oil. We just have a swing high, we come down to B. Look at all the indications in here. That's effort to go up. I can see the high volume in here. Effort to go up with no reward. We get a lot of fuel trying to push the market up, but it's getting capped up here. Somebody's stepping on top of it. And there's only one thing that can do that, and that's selling. And then as the market comes back down, we have an opportunity in here for a nice trade setup. And what we're looking for is at least a minimum retesting of the lows down here at B as a target, and most of the time you'll see it go through if this trade is working well. Of course, again, it's a trade setup. So every trade setup that we have, whether it's a spring or an upthrust, has a probability of working, but it also has a probability of not working. So you need to become familiar with these and work on, excuse me, study the charts, work on your understanding of these, and develop your own sense of probabilities of the trade setup. Notice here, sometimes we'll see the market come back up and test. Not always, but frequently we do. And for those of you who are astute, if we were to draw a line across here, we'd have a second upthrust occurring. So a nice double opportunity there. Okay, so the spring, just the mirror image here. Instead of making a high at A, now we're going to make a swing low. We rally up, and then we fail to go, after we've come back down, we have to penetrate that, okay, that low at A, that swing low, but we're unable to go lower. So we failure to follow through to the downside. Here on the S&P futures, the ES 60-minute, you can see plenty of examples of this. Often we see the markets testing yesterday's low. So for example, a low would have been put in here at A yesterday, market rallies up overnight, and then it comes back down and tests it the next day. I look for this all the time in my trading. Market rallies up, makes a swing low at A, rallies up higher, fails to go down through at C. Notice again, we get a nice, excuse me, testing kind of action here, and that's highlighted by the Trade Guider indicators.
Question here, Gary. What's the best time frame to look for these type of setups? If you pick 60, is that the one? Will you see these in small time frames?
We see them across all time frames. This is a 60-minute chart of the S&Ps. The one before was a daily chart of crude, and I think the one before that was gold daily, gold futures in daily. So you'll see them come up in all time frames. Here's a 240-minute chart, 4-hour chart in crude oil futures. Again, we make that swing low, we rally up, and then fail to go through the bottom of that. And just like I showed you in the upthrust, here we have a test. And we'll talk about that as we get into this a little bit more. And then I'm going to show you, in terms of time frames, I'll show you on a 5-minute chart of the gold, oil, and S&P futures from last week and where these trades set up and occurred. So all the different time frames that we trade, they're all on there. Double bottom is typically tested but doesn't penetrate and go through. The spring has to go through the swing low here at A, and you can see that it does, and then fail to go down, reverse, and close back up above. Sometimes it closes right near, as we see here. Sometimes it's a little bit higher up. We'll see examples of that. But yeah, that's the basic idea. Is there has to be a penetration, as if we're going to continue to go down lower in a spring, and then the market reverses and fails to continue to follow through. It's a very strong indication that buyers are present in the market. Lauren is saying that, okay, we have two things going on here. We have the penetration down here at C that reverses, and then a test in here. So where would you take the trade? There's a lot of different ways to enter. The way I like to do it is to just take the, on the close of the bar that reverses and comes back up against, up above the low of the downswing at A. So in other words, I'm taking the bar on the close. You can buy stop the high of that on the next day if you want to, or the next bar. On the test, you can buy stop the high of the test, having it prove to you that the market is indeed going to continue to take off to the upside. So there are different ways of doing it. You could also do a trend line break, or you can buy the high of the last two bars. There's different ways to enter. But I just like to keep it simple and go in on the reversal, at the spring itself. We don't always get a test. It doesn't always happen. And typically, the more powerful the trade setup, the lower the odds of actually getting a test.
What we often do when I'm looking for those setups is go down to smaller time frames.
Yes.
And Smart Center Pro now will actually identify on the various time frames, I'll show you this later, where that test might not, you never might see it on the 240, but on the 5-minute and the 15, which I use, they're very, very clear. Often, if you just want to repeat that to the audience, that you can go down time frames to find the principles if you wish.
Yeah, so what Gavin is saying is that if we're monitoring here on a 4-hour chart, we can drop down to a 15-minute or a 5-minute time frame and look for in this case, for example, you want to be thinking in multiple time frames at the same time. So if we're looking at a 15 or a 5-minute chart, we'd be actually in a down move here on the, say, the 5-minute chart, and we would be we would get oversold in the downtrend, and then the market would start to reverse, and we'd be looking for the opportunity there. Okay. Also, the Smart Scan plugin will monitor this on multiple time frames and give you indications there as well. All right, let's move on now to trading in a trend. How do you all define a trend, say an uptrend? How would you, what's your notion of how you identify a trend? Anybody? And don't tell me it's a ADX above 30. Higher highs and higher lows. Yeah, exactly right. We'll see a swing high, in the case of an uptrend, a swing high, it'll make a low, it'll make a higher high, and then a higher low. And if it has the right characteristics of volume and structure, we're going to look to take a trade right in here. It's a good spot. It's what I call the sweet spot of the trend. After we've got a trend established with a high, a low, a higher low, a higher high, and now we're looking for that second higher low. In the case of a downtrend, it's just reversed. We get a low, a high, a lower low, and a lower high, and that's where we're looking to take that sweet spots type trade. So here, for example, on the 4-hour chart on crude, we have a high, a higher low. We make a new high, and we come back and we revisit, and we can draw a horizontal trend line across here and look for an opportunity right in this area at B for a trade. Here we have the S&Ps on a 60. We have, here's the question was about double top. You can see that this did not penetrate. Doesn't look like it. Might have actually. It might have been an upthrust there. We come down, make a higher, a lower high, a lower low, and now we're looking for an opportunity to make the trade right in here. Okay. A lot of times in the Wyckoff world, we'll call this breaking the ice. Okay. The story is that a Boy Scout was walking along a river, falls through the ice, trying to get back up. It's kind of a macabre story, but tries to get himself back up, but the river is pushing him down, the current's pushing him down. He keeps bumping his head on the ice and finally expires and goes to the bottom. It's not very cheerful, I know, but that's, you'll never forget how that trade setup works, right? Here you can see on the daily chart, we fall through the ice, come back up, bump our head, fall through the ice, bump our head, all the way down, and then the reverse. Now this is jumping across the creek to give you the story, the Wyckoff story on the other side. Boy Scouts, it's summertime now, so he's the river is not frozen. He's looking for a spot to get across, but it's all too wide because supply is coming in. Finally, he finds a spot that he can sort of jump across, and he does, and then he comes back to the edge of the creek, takes off his boots, sticks his feet in the water, and cools his feet. And that's right here at B, and that's where we're looking for the opportunity to take a long trade. And the same thing up in here. Okay? Any questions about these trades? They're very simple, very simple.
What would the VSA principle be for a spring? I would say that's stopping volume most often, personally.
Yeah, a lot of times you're going to see, yeah, the question is, what's the VSA indications around a spring? Typically, we'll see stopping volume on the first swing low, and then we'll often have testing, either a general test or
no supplies.
No supply, yeah.
Very common indicator. No, yep. 198, 199.
Yep, and no supply testing on the as it comes back down to revisit. We'll see that a lot. Okay, so let's take a look at last week's trading. We'll look at the three futures. People trade these a lot. Very popular. The S&Ps, crude oil, and gold. And everything is going to be on a 5-minute chart now, taking a look at this. All right, so here's Monday, last Monday in the S&Ps, 5-minute chart. What do you all see here? Quiet. Yeah, up thrust right in here. We make a swing high up here at A. We come back down. Notice there is some sort of stopping volume in here. The VSA indication coming up. Then we run up. Look at this beautiful up thrust here. And I would take that right on the close.
You also said that they seem to a breakdown area, like you look to the left, where the market actually brings us down.
Yeah, you can. I'll show you a little bit of this as we go along, but we have what we would call strong ease of movement down, or strong flow to the downside. We see that in the price action. Okay, often see it in the volume, but this is coming in overnight. This is probably in the late European session, late London, or mid-London session, should say. But that volume gets eclipsed by once the U.S. session opens, because there's still more volume in the U.S. sessions than there is in either the Asian or European sessions.
There was a question that I just saw when I'm looking Peter around this is, can you get low volume on up thrusts, or do they always have to be ultra high?
No, you can have, the question is, can you have low volume on up thrust, or do they always have to be ultra high? And I tend to like the more high volume better. Like, for example, on this one, where we have volume coming in here at B, I know that that's a pretty clean indication of selling coming in. Buyers tried to take, here's the idea behind here, the up thrust. Buyers try to take it up. You can see on the way up, they're moving the market up, but it's not moving with ease or with good, strong upflow. There definitely is flow to the upside, but it's not like we're really taking off there. Then the market gets up above the high of A, and we see the volume coming in, and it's basically capping the market at this point. Yeah, there's buyers coming in there. Breakout traders are saying, oh, great, let's go long. But that's what the smart money really is looking for, and they'll step on that, and you see it in the volume.
Just something else to add to that, Gary, which you can mention. The very important part about B is what the next bar does. It closes the low of that bar, and that is we call that confirmation of weakness.
Yeah, and Gavin is saying that the second bar here after B closes down below the low and the close of bar B, and that confirms that weakness that we see on B. Yeah, and Lauren is saying that, boy, you have a lot of high volume here as the market went up on A. As the market's rising up, look at what's happening to that volume. It's not expanding up to the upside. So there really is no fuel behind this. And then suddenly we get this, what I call a pop in volume. Market pushes up, and then we get the swell of volume coming in, or that pop of volume, closes poorly, next bar confirms it, and you're off to the downside. Notice here we have a spring, but the VSA indicators are telling us there's still a lot of supply in the market. You can kind of see it there in the volume and the price action. So if we had taken that, we probably would be, especially as the market's coming down here and revisiting again, be looking to get out, scratch out of that trade real quick. We do have a nice spring here. We have the market make a low, a swing high, and then at C we get a nice sign of strength in here. And notice, I didn't put put a marker down here, but that's the volume. It's the same thing as B. You begin to realize, if you start looking at the charts and start studying this, you begin to realize that this stuff is occurring over and over again. And in the same ways. And that's why I'm kind of highlighting these two trades. They're mirror images of one another, and they occur a lot in the markets, and they're very nice setups to know about. Notice I've got buying coming in here. I've got buying coming in here. We made a low, and the market couldn't go down any further here. I've got buying coming in here. There's some accumulation going on in this area. I've highlighted it. We look for that as well. This didn't play out this day, but it did on the next day. Okay, let's take a look at crude oil from Monday. What happened in crude? We have that high, a higher low, a higher high, and a higher low in here. And as we said, this is a nice sweet spot of the trend. Notice how the volume, as the market comes down, I look for this all the time, as the market reacts after it's gone up on good volume, the volume comes down as well.
Gary, something just to mention there. A lot of people, when they're studying VSA, see high volume on an up bar, and they immediately say, oh, I should short here. But if it's tested within 3 or 4 bars, I took a really good trade on the pound the other day that did exactly that. Mm-hmm. It pushed through, it was a high volume bar, closed on the high, and it tested it 3 bars later. I want to explain that principle. Testing high volume in an uptrend is a very good trade setup.
Yeah. Gavin's pointing out that a lot of folks will say, oh, gee, you have ultra high volume here. And you can see that the indicators are coming in saying there's some supply coming in, potential weakness here. But if the market in the next few bars, as it does here, tests that, then this really is strength. What we would see instead, if this was real weakness, we would see the market start to fall and volume would pick up to the downside. But we don't have that. As the market comes down, the volume stays low, and that's a very good indication that strength exists in the market. Buyers are present in the market, and that's what we want. We want to take the line of least resistance. Yeah, question is on the bar after B, the volume doesn't expand to the downside. Is that significant? We see the volume in here, and then the market comes down. I always kind of view this as the longs being a little shocked. Tom Williams would say that they're, how would he say it? He would say that they're preventing the longs from getting out of the trade, so to speak, right? Trapping them, that's it. They're traps, right? And sometimes you'll hear about bull traps and bear traps. That's really an upthrust and a spring. So while there's not a lot of volume, no one's bailing out at this point. They don't start to do that until down a little bit lower. So I don't really consider that as, would it add to the trade if it were present? Sure, you'd see the supply coming in, but it really doesn't make it doesn't make that much of a difference, truthfully, because really what you've got is supply over here at A on this particular trade and supply over here at B. Question is, are they gunning for stops up here? Maybe people put trades on and over in here, and then they put stops over there. Truthfully, I don't think about that.
Yeah, you can't get it.
Yeah.
Then you've got a level 1 screen. You're not going to see it.
Yeah, I can't really see that, what's going on. So I really try not to think too much. You know, look, I'm a psychologist as well, right? And I used to think about this stuff all the time. And I used to say, oh, this must be what's happening, or they're gunning for stops, or they're covering shorts, or they're getting squeezed, or all this stuff. And I was more focused on that than I was. So I began to realize that the less I think, the better I'm going to be in trading. Now, it's really true.
And now we can all go home.
No, so
lesson, everyone.
Yeah. No, so you don't want to be thinking, oh, where is 4 hours resistance on this chart when you're trading? You need to know that ahead of time. Okay. You don't want to be thinking about, well, should I put my stop 3 points away or 4? You need to have that set ahead of time. You don't want to be thinking about, should I enter on this bar? Should I take a trend line break? Or should I buy stop the 2 bars back? You got to figure that stuff out ahead of time and have that all set. That's what I'm talking about. You don't want to be thinking a lot.
That's what happens to me.
Yeah, and that is exactly what happens to a lot of traders. And I always try to give the advice of get all that stuff down ahead of time so it becomes more automatic for you.
Interesting question for the audience out online as well. How many of you have a trading plan, a written plan? Put your hands up. Yeah. And part 1 of this whole symposium was all about the trading plan. And that's exactly, Gary, what let me just go onto the mic quickly here. I'm just pointing out that the part 1 of this whole symposium was all about having a trading plan that you write down so you've got a strategy. So when you see a principle appear, you know what to do about it. Tom Williams helped me a lot with my plan, and he said, Gavin, he said, you've got to identify which bus you're going to get on. He said, because you're going to be trading and you're going to have about 15, 20 buses coming at you. He says, and you want to get on the bus that's got the best opportunity of making you money. And with Smart Center Pro, what it's done, it's taken out the guesswork of finding those trades because it's doing the hard work behind the scenes. A human being, I mean, someone said to me, you know, Wyckoff never used computers. I said, no, but if they were invented in his day, he would definitely have picked one up and tried to use it because he's a clever guy. But they didn't invent them then. Same with Tom. He computerized this stuff because he said a computer is much better at searching 10,000 charts than a human being is, right?
Absolutely.
That's what this does, as we'll see this afternoon. But no, it's just interesting. The trading plan, we keep going on about it. You have a trading plan, right? I have a trading plan.
This is it.
Well, that's it, yeah.
Gavin makes a very good point, having a trading plan. I mean, this is basically my trading plan. There's not a lot more that goes into my plan. Obviously, I'm reading the market. I'm looking at supply and demand as we go along. I'm looking for the key indications there. But I'm not making a trade over here, for example. I wait until we call it trading at the edge. Trading at, you know, the fellow that I learned from used to say, when you go fishing, You don't get in a boat and row it out into the middle of the lake and pop your line down. Fish ain't there, right? The fish want to be where they can hide and then come out, get their, sculpin or worm or whatever, and then go back. So they're going to be around the logs and the trees that have fallen into the river, the rocks, the structure, the edges. You want to trade around the edges. You want to fish around the edge for structure. You want to look at structure and trade around the edge. Okay, so again, we're in a trend now. We can lay on a trend line, a simple, from the lows here. In fact, I would probably start it with the low here and then here, but then adjust it, okay, once the market does this. Notice I'm not suggesting that this is a trade in here because we really don't get a good clean move there, but we do from E to F. We get that nice drop in volume. We've got two trend lines. We've got the horizontal line from D and we've got the diagonal, what we would call the demand line, where we expect demand buying to come in down here at F. And I use trend lines all the time, simple ones. I don't try to do anything real sophisticated. And I know at this point, somewhere up in here, we're getting overbought in the trend channel. And this is our supply line. It's just a parallel of the demand line put up on top of the swing high here at B. And I know that somewhere in here, I want to take that trade off because it's not likely to continue to go higher. Some people have trouble with that. Every trade has got to be a home run. All we're trying to do is take a piece out of the trend. Not trying to buy the low or sell the high, trying to get a piece out of it. Here's, again, we're only on Monday. Look at how many trades we've gotten so far off of this, right? 5-minute charts, and now we're on gold. Not a market I trade personally, by the way, but I know a lot of people do. And look at what we have here. We had some supply come in at A. Market drops precipitously here, comes back up, makes a high at B, kind of double tops the A and the swing high at A, and then comes up and up thrusts at C. And we get indications of weakness coming in. You can, essentially buy anywhere in here on C. Your stop would be above the high of C, or as the market comes down. And then we get a spring. Market's rotating here. It's a rotational day. In other words, it's not trending. And springs and upthrusts are great on rotational days, and we see those a lot in the markets. As I said, this is not a market I trade. It's a pretty wide stop there. I know I get questions about that all the time. Well, gold, pretty volatile. Personally, I wouldn't, but if you want to trade it, trade small. Don't put a gazillion contracts on. Just put one or two. Tuesday, crude oil. We've got our swing, our sweet spot in the trend. Notice how we make some nice, good volume going up on A. We come back and test it. On B, the volume recedes. Same thing happens on C. Volume expands to the upside. It's demand coming in. We get a couple of VSA indicators in there suggesting that there could be potential weakness. But as we look, we see the next couple of bars are really testing that high volume and showing us that the trend is still up. And we're making higher highs and higher lows. So you've got opportunities in there for that. Okay. Gold on Tuesday, we get an upthrust here earlier in the day, and then towards the end of the day. This happens a lot in the futures. The afternoons will get more trendy than the mornings. I always trade the S&Ps pretty much. My personal trading is about S&Ps and crude, and we see, especially in the S&Ps, you'll get some trendiness in the afternoons. The mornings are going to be more rotational. If there's going to be a reversal, it usually happens in the mornings. Not always, but the tendency is there for. Okay, this trade here at G, I put this in. It's a little bit of an advanced idea. Notice that because we don't have a lower high at this point. It's not quite the same as we were seeing on the sweet spot, but it's still a pretty nice indication here. And this, we see supply coming in from D to E. We see that volume expanding to the downside now. Earlier, go back to the crude. We see volume expanding as the market goes up, and then we start to see the volume recede as we get pullbacks. Look at what's happening here. It's just the opposite. Volume is expanding to the downside at E, then again from E to F, or down here to F. So we know that there's supply that exists in this market, and it's just trying to hammer its way down. We come up and we get really no demand in there. A very light amount of volume compared to what we see at E and F. And then as the market starts to fall, there's an opportunity for a short trade. A little bit, not quite as clean as the sweet spot, but with the supply in the background, it's... So how are we doing for time?
Oh, you've got another 25 minutes.
Okay.
We're going to break? Yeah.
Yeah.
Say half an hour.
Okay. So here we are on Wednesday. The S&P's on a 5-minute chart. We get a spring in an uptrend. That's nice. So we've got the uptrend behind us. Market pushing higher, and then it comes down and gives us a nice little spring action, which is quite tradable. Makes a new high here. A lot of volume comes in, so is this the end of this uptrend? Well, maybe, because we get some pretty high volume in here, but the market fails to go down. It's as if the market comes down here at E on this bar, calls out the sellers and kind of challenges them, says, come on, you guys, you want to sell the market? Here's your opportunity. And it doesn't happen. It fails to follow through. Okay? So there are actually two springs here. We take the trade here. That may not work out for us. Not all of these trades do work out, but E does. We get a pretty decent move up. Wednesday on crude oil, get this big drop down and a nice little upthrust. Now, notice that the market doesn't quite come all the way down and go and test the low of A or go through it. As I said earlier, we're typically looking for the market to push through and create a new swing low here, right? But it doesn't happen in this instance. We can see that the volume just doesn't come out to the downside. That would be our sort of the flag, if you will, to signal to us that we want to be more cautious in this. We start to see buying coming in here, and we'd want to be exiting that trade. So this is one that I'm not going to just show you all the good ones that occur. This one doesn't work as nicely as we would like. Still works. I mean, you still have a good trade. It just doesn't give you the kind of trade that we would typically be looking for. Look at this. This is a great chart here. I thought this actually was the one you were putting up earlier, but look at this. We have some stopping volume down in here, probably climactic action, in fact. We rally up. Volume comes out as we rally up to B, and then it recedes here at C, okay, telling us that demand is in the market. I don't see a trade here, though. Okay, I don't really see a trade, personally, for my playbook. We push up. We make a higher high at D. Look at the volume expand. That's really nice. We come back, we create that sweet spot. There's my trade, okay? Am I crying in my soup because I didn't catch this? No, not really. I don't care. Okay, that didn't happen for me, but this does. We rally up, look at the volume. There's ultra high volume, right, on F. And Trade Guider gives you a great signal there, climactic action. And we get, I love this look, by the way. We get an upthrust in here at an overbought level in the trend channel with very high volume coming in. And it's almost like railroad tracks. We get that big push up and then a big push down. Volatility is obviously here, but it's also a great spot for a short opportunity.
Yeah. Look at bar F. Why would it close almost exactly in the middle of that?
Question is on bar F, why does it close in the middle? Okay. So we're in an uptrend. Buyers are coming in. This is a known spot of resistance. When I look for support and resistance, I want to find the obvious ones. I want to find the ones that everybody sees. I don't care about Fibonacci numbers and traders' pivot points and, hidden stuff. I'm not interested in that at all. I used to be. I was a fib trader for several years trying to make that work. I never could do it, for me personally. I'm not saying it's a bad thing. Just I don't like hidden support or resistance. I want to know. I want every trader to be seeing that. Okay, so let's take a look. Here we are, S&Ps on Thursday. We get an up thrust right at the very beginning of the day. We often see this where we get, people will say, oh, it's so volatile, but a lot of times the open is a great spot for opportunities to emerge. As we come down, though, notice what happens. We get that volume coming in here, and it starts to die off. Even though the volume expands a little bit, this is what we call shortening of the thrust. If we were looking at this, we make a good move down here, pretty good move down here, but look at what happens here. Not that much of a drive down. And we can use a reverse use of trend lines here. This is a demand. Typically in a downtrend, we're looking to identify the supply, so we always want to draw our supply line first, and that would be coming in from the tops here, right? Because that's where supply is. We know supply came in here, and it came in here, so we might draw a trend line initially to A, adjust it for B. Yeah, so we have some shortening of the thrust there. Here we get sort of this idea of a more advanced kind of I would call this maybe a first higher high, where we're breaking the highs here of all this congestion, and in the middle of the day or the end of the morning, and then we get a nice little pullback in here. Can look for an opportunity at that point. Crude on Thursday. Nice volume expanding to the upside on A. We have a good trend going on. We come back. Now look at what happens here. We get that sweet spot set up, and it's also a spring. Springs, when they occur on top of what had been resistance in here, now turns into support. Right? This is the creek backing up to the edge of the creek, and then we get a spring on top of it. I like that look a lot. I'm looking for that all the time. And we get it again over here. Second spring in a row for this day. And pretty nice. And you can see that volume's not really expanding to the downside. We're in a good trend to going on up. One of the things with diagonal trend lines, let me just highlight this. I like horizontal best because they don't move around. Diagonal, you would lay this on, but it's subject to change depending on how the market acts. Horizontal support and resistance don't change. So I always prefer that. And again, keeping it simple. This is later on Thursday with crude oil. Holy mackerel, what do you do with this? I just, don't bother with it. This is too crazy for me. Do you want to try to take this in here as an up thrust? No, it's too much going on here. Bob Evans, who took over Wyckoff Associates a few years after he died. He actually knew Wyckoff. He was a young fellow. Had a lot of conversations with Wyckoff. After Wyckoff died, a fellow by the name of Bob Stanislaus bought Wyckoff Associates and continued this is the educational arm of Wyckoff, continued that, and eventually Bob Evans became the owner of Wyckoff Associates. And he was an active trader from the 30s all the way into the 60s when he retired. And he used to do these tapes that were just amazing. He used to listen to. I took the train in. I used to live in New Jersey and took it into Lower Manhattan every day, and it was a 40-minute ride. And Bob Evans would have a 35-minute tape, and I would put it in the cassette player and listen to it going down and then another one coming back up. Anyway, he would always say that the market has to be well behaved. We want to have, are the Wyckoff principles playing out on the market that you're interested in? They're not here. And so if they're not, we don't bother with it. Gold on Thursday, a little bit better. We get a nice upthrust in here. Look at the volume expanding both to the upside and then to the downside, indicating that there is a lot of supply in this market as it tried to push up. Friday in crude, lovely kind of sweet spot trade. This is an upthrust in a downtrend, kind of bumping the head against the ice. So we get both upthrust and the sweet spot trade. And it's very nice. Gold on Friday. Here's something that is, we see supply come into the market here, right? Then we come back up and revisit this area. We want to know that that supply exists, and we want to pay attention to that, because the markets do this a lot. They come back up and they test those areas. And in this case, we get a nice test of this supply with an upthrust at D. And the trade guider signals all this effort versus result here, trying to push the market up. You can see the volume is eclipsed a little bit graphically because of this high volume here. If we didn't have this on, you'd see that this is pretty good volume in here. And they're trying to drive the market up, but they're not able to do it. Because why? Because sellers are stepping in. Why are they stepping in? Because they know from back here that this market is weak. As Tom Williams would say, this does not go away. Right?
I'm looking at an example here. I don't know how we picked the day to do this. The 6C, the Canadian dollar.
Canadian dollar has got some stuff
I mean, I'll let
going
you
on.
carry on, but you're looking at almost it's slightly different. You've got that thrust in the back, and it's gone back up on no demand. And at the London fix, they've taken the whole thing down.
And they've taken the whole thing down. Yeah, as I say, this happens quite a bit. So let's take a look. I'm just about done with this. Let's take a look at these three setups. I'm sorry, these three markets and these two setups. The spring up thrust being one, and then the sweet spot trading being the second. And just to look at the numbers, we had two up thrusts, three springs, and two trend sweet spots in the S&Ps for a total of 7 trades setups. In crude, 2, 2, 4 for 8. And in gold, you've got 7. So you got 22 setups where you don't have to be a rocket scientist to do these, right? What I'm trying to point out is that these occur frequently if you're intraday trading in the futures markets. So look, watching 3 markets would be tough for me. I couldn't do that. I'd get rid of one. So let's say you looked at S&Ps and crude oil. That's 15 trades setups that occurred. 2 a day. My goodness, that's great trading, right? Great trading opportunities. Yeah, questions?
When you count the upthrust, do you count just clean upthrust or both clean and hidden?
No, just the clean. The question is, am I counting just clean upthrusts, or am I also including hidden upthrusts in this? No hidden upthrusts. This is just clean upthrusts.
You might want to explain what a hidden upthrust is, because it's closing in the bar behind it. People always get confused with that.
Yeah, and the best way that I can think about it is that it's really an upthrust on a smaller time frame. That you might see it on the 5-minute, but it would, if you drop down to say a 1-minute time frame, you would see it more clearly as a clean upthrust there. But we're not using the 1 minute. I'm just using a 5-minute chart for setups. Now, that being said, you can do yourself a big favor by understanding how time frames interact, noting where there is, as I showed you in the very beginning, the S&Ps on a 60-minute chart with springs and upthrust. We often will be testing yesterday's low or yesterday's high, or the 4-hour high or low. So having that kind of higher time frame market structure in your mind when you're trading is a very good thing to do, because then we can see that, okay, well, this morning the the market bounced off of yesterday's low and it's starting to ride up, and now we have a spring opportunity setting up. That adds to our trading here. But the point is you don't have to, my whole point of this, and this is my playbook, you don't have to do a lot of hard work at this. I mean, you do. So let me also say this. This is important. You cannot look at this presentation and say, okay, I'm going to start trading springs and upthrusts. This is great. And then go into tomorrow's market or this afternoon's market and think that you're going to be able to do this. Although it's simple, it's really not that easy. And what is really needed is you've got a level of knowledge that's been conveyed, right? You need to make that knowledge, you need to reinforce that with some experience. So I would encourage you to, with anything that you want to do in trading, any trade setup that you want to do, the markets that you are interested in trading, get 6 months of data and look for these and study them, understand them. Then what I would do is I would sim trade these. People look at me and say, well, there's no money behind it. How can you do that? You really do want to do that. You want to practice this. Think about an athlete. I like to play tennis, right? If I were a professional tennis player, I wouldn't dare think about setting foot on the court to go play at Wimbledon or the U.S. Open or any professional venue without having a lot of practice behind me. And that's really the case in trading as well. You really want to put some time and energy into practice. Yeah, question?
To keep multitasking to a minimum, to uncover those 15 trades in the S&P and crude, in real time, how many time frame are you watching?
Question is, how many time frames am I watching during the course of the day? I certainly know what's happened and happening on the daily. The daily is kind of where the support and resistance are going to be seen the best. And I pay attention to the hourly, and I'll sometimes bring up the 15-minute chart, more for volume characteristics. Sometimes it's the compression of the data shows it a little bit more clearly. But just as often I don't. So the 60 and the 5-minute chart, that's what I'm working off of. So on my screens, I don't have a gazillion monitors. I've got 2. And, well, 3. But one I don't really use for trading. I just use 2. And I've got 60 and 5 on one for crude and 60 and 5 on the other for S&Ps. That's it. Keep it simple. I find that really important. Any other questions or questions from the Ethernet here?
Yeah. Robin says, great presentation. Have we recorded it? You can answer yes.
Oh, yes, we have recorded it. Robin, the question, she asked if we recorded it, and we do. We did. As Gavin's looking through the questions, one of the things that I do with traders is every Thursday night, I meet with a bunch of them online, and we go for 90 minutes, and we do simulation trading. And I encourage them to show me where they want to take trades, how they're going to manage it, where they're going to get out of the trade. And invariably, mistakes are great, by the way. When folks make an error, it's terrific because we have an opportunity to learn. No one's browbeaten or punished for it. You know, we have a tendency to want to be perfect all the time, and perfection is very overrated. Let's put it that way. You want to make errors, especially in practice, and learn from them. And that's what we do in what we call it deep practice. It's based on about 45 years worth of really good psychology about what makes really great performers great performers. What makes experts expert. And I've kind of distilled that down into a basic program with traders, and so we get a chance to do that every Thursday for 90 minutes. And also invariably somebody comes up and says, well, gee, I really thought that was, we have an opportunity to talk about trading psychology, the mental side of the game as well. So not just the technical side, but we also bring in what's going on between the ears, which is often very helpful. So for those of you who don't know, my website is tradingpsychologyedge.com, and you can see me there. This is my email address. You're welcome to send me questions that arise afterwards, or comments or questions about anything in trading.